Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the arguably more bullish scenario where we're looking for a 3-wave A, a 3-wave B and a 5-wave C to the downside in an expanding flat. After wave C, we're looking for a move back up. Most common target for your wave B has been hit, the 1.236 to the 1.38 Fibonacci taken from the start to the end of wave A. Any minimum target for your wave C would be taking the low of wave A at 56.1k. The most common flat structure is an expanding flat, which is what you see on my chart, A, B and C taking the low of A. There is only one flat structure that does not take the low of wave A, and that is a running flat, A, B, C and then move up, but a running flat is the most rare flat structure, never preferred unless all of the other stuff fails, so therefore probabilities with this particular scenario are highest to take the low of A and move below 56.1k. Now below that low of wave A, we do have two other areas of additional support. First of all, the blue box here, 54.6k to 55.3k and 52.3k to 53k. What does impact the probabilities for this scenario is time. You can see two vertical lines on my chart, a 5 and a 6 fib time taken from the start to the end of this move. Now the reason I have this fib time on my chart is because we have to compare this flat structure with the first structure to the upside. If this is a corrective move in an expanding flat ABC, then this move has to be labeled as either a wave B, a wave X or a wave 2 in a bigger ABC, WXY, or a more bullish 1, 2 and then a wave 3 towards the upside. So by all means, this structure in time has to be compared with your first push to the upside. But it is a very long sideways structure. You can see we have already passed the 5 fib time, again taken from the start to the end of this first move. So that means this move is already 5 times longer in time compared to the structure up, which is not something that you like to see and does lower the probabilities for this particular scenario. Now, if we do think about this being a flat structure and another push to the upside, what has then the highest probabilities? A 1, 2, 3 impulse to all-time high, a WXY corrective structure, or an ABC corrective structure? Now, in this case, a 1, 2, 3 impulse would have the lowest probabilities, 1, 2, 3 to the upside. And the reason is that your wave 2 is so incredibly long. The common target for your wave 2 from a time perspective is the 3A2 to the 2 fib time. And now you're at the 5 fib time moving towards a 6 fib time. Now, it is more common for a wave X or a wave B to be longer compared to a wave 2. So by all means, a WXY or an ABC, if you do turn out to have this flat here, would have a higher probability compared to an impulsive 1, 2 and a 3 to the upside. Your most bearish scenario is quite simply a finished WXY double zigzag structure and looking for an impulse to the downside, where this move down is counted as a wave 1, look for a 3 wave 2, continuation to the downside to new lows in a wave 3. What is very important here is that we want to see a volume decrease as price is moving towards the downside, creating some lower lows. At the moment, you can see that in this most local structure to the downside, the highest amount of volume is in the latest move. What we like to see is a couple of 4-5s on a lower time frame, which is the range that I have here, because we have a 1, 2, 1, 2, 1, 2, 3, and then we want to see a 4, 5, 4, 5, and then another 4, 5. Now, while we are forming the different 4-5s, we want to see the volume decrease as price is making new lows. And when we see that it supports the narrative to then end your first wave 1, look for a bounce towards the upside in 2 and then another 3 towards the downside. Now you can see that the price action is actually quite similar compared to the arguably more bullish scenario, because here you are looking to end an impulse to the downside, wave 1, and then look for 2 towards the upside. But in the more bullish scenario, you're also looking for an impulse to end, because this wave C by itself is also an impulse. So also 1, 2, 1, 2, 1, 2, 3, 4, 5, 4, 5, 4, 5, and an impulsive structure over here. But then you're looking for continuation to the upside, right? If you are most bullish. And the difference between the two is that after wave C, you want to count impulsive structures to the upside, right? 5 wave moves. And in the bearish scenario, you want to look out for corrective structures in a wave 2, and then you dump to lower prices. That is the main difference between the two scenarios. Now, if we then zoom in to the 1 hour time frame, then what you can see here is the move to the downside in a bit more detail. And this is, of course, if we are looking for a wave C or a wave 1, as just explained. You want to see an impulse to the downside, so we then have a 1, 2, 1, 2, 1, 2. Highest volume move to the downside is then always labeled as your wave 3. And then you're looking for a 4, 5, 4, 5, 4, 5. Now what you see on my chart is a couple of 618s. Now because this move to the downside has the highest volume, let me show that once again. Here you can see the volume peak. So in this move down, highest amount of volume here, which is by far most commonly in a wave 3, which is the reason that I labeled this wave 3 in white. And after this, you're looking for 4, 5, 4, 5, 4, 5, where volume slowly moves down. But what you don't want to see, for the bears at least, is price moving to the upside, touching this 0.618 at 60.6k, taken from the high of 2 to the current low on the chart. This would invalidate a wave 4, increase the probabilities that this is a 3-wave structure, not an impulse, which would be good for the bulls. Now for the bears, of course, we do want to see the low of this wave 3 taken. Range a bit for a wave 4, move down again for your wave 5 in white, to then finish your blue wave 3. Now the moment you take out this low, before touching 60.6k, we remove the white 0.618, we put our 4 here, we then have our 5, and then the blue 618 is taken from the high of your blue 2 to the low of wherever your blue 3 is going to be. And now you're going to be looking for this blue wave 4. Invalidation of the blue 4 is the 618. And if after a bit of a range you move towards the downside again, taking the low of blue 3 without touching the 618, then you're going to remove the blue 618, take the green one taken from the high of your 2 in green to wherever the low of your green 3 is, and then this is going to be your invalidation for your green wave 4. I hope this is not too complex, but basically what we're doing is we are keeping an eye on the invalidation of wave 4, which at the moment means keeping an eye on 60.6k for your white wave 4. So in an impulse, we want to see this low taken before price taking out 60.6k, and because we have the highest amount of volume in this move to the downside, the probabilities are highest, and also it's easiest to look for an impulse to the downside, 1, 2, 1, 2, 1, 2, 3, 4, 5, 4, 5, 4, 5, until an invalidation would be hit, which is the 0.618 for your white wave 4, which at the moment is not hit. So the probabilities are higher to move down unless you take this level here at 60.6k. As long as you don't hit it, the probability is higher to move down. Now yesterday, we have been talking about the 886 touches quite a lot in the content actually, and that is because the probabilities were all the time higher to move to the downside. And I just wanted to show the relevancy of knowing that 886 rule, or actually 886 guideline. It's not an official Elliott wave rule, it's not an official Elliott wave guideline, but it's something that I talk about on the channel a lot because it is so incredibly valuable to know. The moment an 886 is touched, probabilities are higher to take the low. Reason is that the 886 is common for a wave B or a wave X and rare for a wave 2, meaning any move to the upside has a higher probability of being corrective in a C or Y, increasing probabilities to take the low. Now we saw it here, move up, 886 touch, move up, and eventually took the low. Same on a lower time frame here, move up, touch 886, bit of a structure up, and then eventually took the low. Once again here, move up, touch 886, move up again, and take the low. Keep an eye on those 886s. They are very, very relevant, especially in a trending environment, right? And it increases the probabilities to take the low. And yesterday was a perfect scenario where you saw this 3 times in a row. If we then finally look at the CVD divergences, they played out nicely as well. Bearish CVDs with every bounce we had towards the upside. lower high, higher high, lower high, higher high, lower high. That's what we're looking for with CVD divergences, lower high on price, higher high on the CVD. All these bearish CVDs have played out, and even here more locally, the bearish CVD played out. You can see prices forming some bullish CVD divergences. However, after a fast move to the downside on a high amount of volume, the bullish CVD divergences are not trustworthy unless you are going to change market structure to the upside. So the bullish CVDs here, for me, are completely irrelevant. What I would need to see is structure to the upside, and then see bullish CVDs forming as price moves up. You got to change that structure, which at the moment is not the case. The bears are in control, and therefore the bearish CVD divergences are more interesting. And if we then finally look at the probabilities of the different scenarios, and on the 4-hour time frame, the probabilities are highest to take out this low at 56k. Then look for support and a bounce, which is for the bears a wave 2, and for the bulls it is a wave Y, C, or a wave 3. So in other words, for the bulls we're looking for this flat price to find support, move to the upside in a Y, C, or a wave 3. I explained the probabilities between those 3 scenarios. And for the bears, you're looking for a wave 1, 2, and then a wave 3 to the downside. Now that only counts if volume is decreasing in both of these scenarios. If price moves to the downside with volume increasing as price moves down, right, then I'm not looking for an impulse yet to end in a couple of 4-5s, and we have to take into consideration continuation to the downside. On the 15-minute time frame, the probabilities are highest to take out this low again. The highest volume is in the recent move to the downside, so naturally one then looks for an impulsive structure first, which is easiest to recognize and also easiest to invalidate. And that's what I mean with counting this as a 1, 2, 3, 4, 5 wave structure. Highest probability, easiest to recognize, easiest to invalidate as well. Hitting the 618 at 60.6k invalidates a wave 4, increases probabilities for the move down to be a 3-wave structure, which would be bullish. If price, however, takes this low first, the impulse is very much on. I hope that this video was helpful or valuable to you. Please check out the brand new complete Elliott Waves Guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.